In today's video, we're tackling personal loan myths and misconceptions head-on. Personal loans can be a useful financial tool, but loan misconceptions often scare people away. We're here to set the record straight and reveal the truth about personal loans. Did you know, for example, that the average personal loan interest rate is around 12%, much lower than credit card rates over 20%? Yet Americans hold hundreds of millions of credit cards, but only tens of millions of personal loans. Why the gap? Myths and misunderstandings play a big role. Myth number one, personal loans are hard to get. Applying for a personal loan is complicated, and approval is nearly impossible unless you jump through endless hoops. Many people assume that because personal loans are unsecured, no collateral required, lenders make you fight an uphill battle to qualify. Getting a personal loan is often easier and faster than you think. These days, personal loans are easier to get than many borrowers expect. Typically, if you have a steady income and decent credit, you have a solid chance of approval. In fact, unlike a mortgage or auto loan, there's minimal paperwork. No home appraisal or vehicle inspection needed since there's no collateral. Many online lenders even offer same-day or next-day funding, far quicker than the weeks it might take for, say, a home equity loan. Think about it. You fill out an application, often online, provide basic documents like ID and proof of income, and wait for a decision. Some lenders can approve qualified applicants within minutes and deposit funds within a day or two. It's that straightforward. The process has improved a lot with technology. No more daunting, drawn-out bank meetings for a simple loan. Myth number two, personal loans have sky-high interest rates. Personal loans are always an expensive way to borrow money. Their interest rates are outrageously high. This misconception often comes from confusing personal loans with payday loans or other high-cost loans. If you've heard horror stories of triple-digit APRs, it's easy to assume all personal loans carry insane rates. Most personal loan rates are much lower than credit card rates and nowhere near predatory payday loan levels. Yes, personal loans are unsecured, so their rates are generally higher than secured loans like mortgages. However, compared to other unsecured credit options, like credit cards, personal loans usually offer far lower interest rates. As of late 2024, the average personal loan APR is about 12.3%, whereas the average credit card APR is over 20%. That's a big difference. In fact, if you have good to excellent credit, you might snag a personal loan with a single-digit rate. Some highly qualified borrowers see rates around the mid-single digits, in the ballpark of 6 to 8% or even lower. Competition among banks, credit unions, and online lenders helps keep rates competitive. Why do people think rates are sky-high? Partly because of payday loans in the news. Payday loans are a type of ultra-short-term personal loan that indeed charge triple-digit APRs, truly predatory rates. But a standard personal installment loan is a different product. Reputable personal loans typically cap out around 35 to 36% APR, even for bad credit borrowers, and most charge much less. For perspective, a 12% loan versus a 25% credit card can save you hundreds in interest on a balance over time. So, don't assume personal loans are unaffordable. If you shop around, you can often find a reasonable rate that beats carrying a balance on a high-interest credit card. Lenders want your business and offer competitive terms to attract borrowers. Always compare offers, and you might be surprised at how budget-friendly a personal loan can be. Myth number three, taking a personal loan will wreck my credit score. Even just applying for or taking a personal loan will immediately and permanently hurt your credit. Many fear that a new loan means a lower credit score, either from the application ding or the added debt. A personal loan can actually help your credit in the long run, as long as you borrow responsibly. Here's the breakdown. When you apply for a loan, the lender does a hard inquiry on your credit report, which may shave a few points off your score temporarily. That's the short-term dip people worry about. If you apply with multiple lenders, multiple inquiries could compound that effect. So it's wise to pre-qualify with soft inquiries first or apply within a short rate shopping window. However, this initial impact is usually small and short-lived. The true credit story of a personal loan comes after you take it out. Making on-time monthly payments on a personal loan builds a positive payment history on your credit record, which is a big factor in your score. As you repay the balance, your overall debt decreases over time, potentially improving your debt-to-income ratio and credit utilization. In essence, the long-term benefits of responsibly repaying a personal loan outweigh the short-term hit from the inquiry. Many borrowers actually see their credit score recover and even improve after several months of timely payments. Of course, if you miss payments or default, that will hurt your credit, but that's true of any debt. The key is to borrow an amount you can afford and then make your payments like clockwork. Some myths have a kernel of truth. Yes, your score might drop a few points when you first get the loan, but it's not a credit death sentence. In fact, using a personal loan to consolidate credit cards can boost your score by lowering your credit card balances, improving your credit utilization ratio, and creating a clear plan to pay off debt. Myth number 4, you need perfect credit to get a personal loan. Only those with excellent, top-tier credit scores, say 750 or above, can qualify for personal loans. If your credit score isn't stellar, don't even bother applying. This myth can discourage a lot of people from seeking a loan when they need it. Personal loans are available to people with a range of credit scores, not just the elites. It's true that having a higher score gets you better interest rates and terms, but you do not need a perfect score to be approved. Many lenders accept applicants with fair or even poor credit. Some personal loans are designed specifically for those with lower scores. In fact, personal loans are available for credit scores as low as 500 or even below, though the trade-off is a higher interest rate or fees. According to personal finance experts, assuming middle-of-the-road credit, around 640, automatically disqualifies you is patently false. Plenty of everyday people with moderate credit and income get loans approved. Lenders understand that not everyone has perfect credit. They look at your whole financial picture: income, employment, existing debts, and yes, credit history. If you can show the ability to repay, you have a shot. Many credit unions and online lenders, for example, actively cater to borrowers with less than excellent credit. You might pay a higher APR, but the option is there. Additionally, you can sometimes add a co-signer with good credit to improve your chances. The myth likely persists because the best advertised rates are for excellent credit, giving the impression that lesser credit need not apply. In reality, people with average credit get personal loans all the time. They just might get a slightly higher rate or a smaller loan amount. And remember, taking that loan and repaying it responsibly can be a stepping stone to better credit down the road. Myth number 5, personal loans require collateral, like a house or car. If you want a personal loan, you must put up collateral such as your car, house, or other assets. Otherwise, no lender will trust you. This misconception blurs the line between secured loans, like auto or home equity loans, and personal loans. Most personal loans are unsecured, meaning no collateral is needed at all. You don't have to risk your car or home to get a typical personal loan. In fact, unsecured personal loans are far more common than secured ones. Lenders approve these loans based on your creditworthiness and ability to repay, primarily looking at factors like your credit score, income, and debt-to-income ratio. If those check out, they'll lend you money without any specific asset as guarantee. Now, it is true that secured personal loans exist. Some banks or lenders offer an option where you put up a savings account, car title, or other collateral to get a loan. This can be a way to get approved with poor credit or to secure a lower rate. However, those are not the norm. The vast majority of personal loans issued, especially those you see advertised online or from your bank, are unsecured. As one credit union points out, most lenders don't require collateral for personal loans, focusing instead on your income and credit history to make their decision. What does this mean for you? It means you can borrow without directly endangering your assets. If, heaven forbid, you fail to pay, the lender can't automatically seize your property, though your credit will suffer and they can pursue legal action. Of course, never borrow more than you can handle just because it's unsecured. But rest assured, a standard personal loan doesn't demand collateral upfront. Your signature and promise to repay, plus a credit check, are usually enough. Myth number 6. Personal loans are only for one specific purpose or only for emergencies. A personal loan can only be used for certain things. For example, only personal or household expenses, or only as a last resort emergency fund. Some people think it's wrong to use a personal loan for anything fun or non-essential, or conversely, that you can use it literally for anything at all without restriction. There's confusion here. Are personal loans tightly restricted or completely free use? Personal loans are versatile. You can use them for almost any legal purpose, from consolidating debt to paying for a wedding. But there are a few specific prohibitions. Let's break it down. Most lenders advertise that you can use a personal loan for just about any legal purpose. Common and perfectly acceptable uses include debt consolidation, combining high-interest debts, like credit cards, into one loan with a lower rate. Home improvement, funding a remodel or repair, new roof, kitchen update, to increase your home's value. Major life events, covering big expenses like weddings, moving costs, or even a dream vacation. Medical bills or emergencies, paying off unexpected medical expenses or other urgent needs. Big purchases, buying furniture, a computer, or other significant items, and then paying over time. In short, almost any personal or family expense is fair game. One credit union notes that people use personal loans for home repairs, vacations, wedding costs, and more. It's really up to you. They aren't limited to personal use only. You could even use one for business needs if the lender allows. The flexibility is a big perk of personal loans. However, be aware of the few exceptions. Virtually all lenders prohibit using personal loan funds for a home mortgage down payment or to pay college tuition. Why? Mortgage regulators don't allow borrowing a down payment. You need to come up with that from savings. And education loans have their own rules and loan types. Trying to use a personal loan for these purposes could get you in legal or financial trouble. Aside from those, as long as it's legal and within the loan agreement, you can likely use the money for it. Just borrow responsibly. Even if you could use a loan to fund, say, a luxury vacation, make sure that fits your budget. Myth number 7. All personal loans and lenders are basically the same, so it doesn't matter where you borrow. It doesn't matter which bank or lender you choose for a personal loan, they all offer similar rates, terms, and service. In other words, shopping around is a waste of time, and you might as well just go with the first offer or your own bank by default. Some people also lump all personal loans together without distinguishing reputable lenders from predatory ones. There are huge differences between lenders and loan offers. It absolutely pays to shop around and choose carefully. Personal loans are offered by banks, credit unions, and a host of online lenders, and each will have its own interest rates, fees, like origination or late fees, loan terms, and customer service quality. You want the loan that best fits you, not just the first one available. For example, one lender might offer an 8% rate with no origination fee, while another offers 12% plus a 5% fee. Some lenders have flexible repayment terms or better support if you hit a hardship, others don't. These are big differences. Also, consider the type of lender. Credit unions often have lower rates for their members than big banks. Online lenders might approve you faster or specialize in certain credit profiles. And importantly, avoid confusing personal loans with payday loans or bad credit loan scams. A myth we touched on earlier is that all loans are equal. Not so. Payday loans, for instance, are drastically different. They usually give smaller amounts, require repayment in weeks, and charge extremely high fees. They can lead to a debt spiral if you're not careful. A mainstream personal loan, on the other hand, has a clear installment term and regulated interest. As one article put it, after reviewing the facts, it's easy to see payday loans bear little resemblance to a mainstream personal loan. So it does matter where you get your loan. Compare offers from a few reputable institutions. Look at the APR, fees, term length, and any perks or drawbacks. Read reviews or talk to trusted financial advisors. A little shopping can save you a lot of money and hassle. Remember, you want low rates, transparent terms, and good service. And if a lender seems sketchy or is pushing you into a loan you don't understand, walk away. There are plenty of fish in the sea. Myth number 8. You can only have one personal loan at a time. If you already have a personal loan, you're not allowed or able to take out another. You must finish paying the first loan before getting a second. This sounds sensible on the surface. After all, can you really juggle multiple personal loans? You can have more than one personal loan at a time, as long as you can afford to repay them. There's generally no rule that limits you to one. Lenders care about whether you meet their criteria and can handle the payments, not whether you have zero or several existing loans. If your income, credit, and debt situation support another loan, many lenders will consider your application. As long as you have the income to repay, there's nothing keeping you from carrying more than one unsecured personal loan, notes an expert. It's not uncommon. For example, someone might take one personal loan to consolidate past debts and later take another for an unexpected home repair or a major purchase. However, keep in mind, each new loan will be evaluated on your current financial picture. If you already have a loan, that monthly payment is part of your obligations. If you ask for a second loan, the lender will check that your debt-to-income ratio isn't stretched too thin and that your credit score is still solid. If you've kept up with payments on the first loan, that actually reflects well on your creditworthiness. Many people successfully manage 2 or even 3 installment loans at once. Think a car loan, a personal loan, and maybe a small home improvement loan concurrently. One caution: just because you can get multiple loans doesn't always mean you should. Be careful not to overborrow and overextend yourself. But if you genuinely need another loan and can handle it, don't let the myth of one at a time stop you from exploring that option. Myth number 9. Personal loans trap you in debt for years and years. Once you take a personal loan, you'll be stuck paying it off forever. It's like digging a debt hole you can't get out of, with endless payments. This myth often comes from hearing about people who only pay the minimum on credit cards or who refinance loans repeatedly. Personal loans are actually designed to get you out of debt on a set schedule. They have a clear end date, unlike credit cards. With a personal installment loan, you borrow a fixed amount and repay it in fixed monthly payments over a finite term, usually anywhere from 12 months to 5 years. In fact, many lenders offer flexible terms around 1 to 5 years, so you can choose a payoff timeline that suits your budget. This means from day one, you know exactly when the loan will be paid off if you stick to the plan. For example, 36 payments and I'm done. There's light at the end of the tunnel. Contrast that with credit card debt. If you only make minimum payments on a credit card, you could literally stretch repayment out for decades and pay a ton in interest. That's a debt trap. A personal loan forces discipline, a set payment amount, and a set payoff date. You can even pay it off early in many cases, because most personal loans do not charge prepayment penalties. Always check your terms, but many lenders let you pay ahead or refinance without extra fees. If you come into some extra cash and want to clear the loan, you can do so and potentially save on interest. Of course, if you take on too many loans or borrow more than you can handle, you can get into trouble, but that's true of any credit. The point is, a personal loan by itself isn't a perpetual debt trap. Used wisely, it's a tool to consolidate debt or cover expenses and then be paid off in a defined period. Many borrowers appreciate having that end date motivation, which can feel more manageable than revolving credit. Also, personal loans often carry lower interest than credit cards, as we discussed. So, far from trapping you, they can help you escape the revolving debt cycle by giving you a structured path to zero balance. The myth that loans lead to never-ending debt really comes from mismanaging debt, not from the loan product itself. With good planning, a personal loan can free you from high-interest debt faster. Myth number 10. You should always borrow the maximum amount you're approved for. If the bank is willing to lend you a certain large amount, you should take it, even if you don't need all of it right now. It's better to have extra cash on hand, right? This line of thinking tempts borrowers to maximize their loan, treating it like free money to grab. If the bank is willing to lend you a certain large amount, you should take it, even if you don't need all of it right now. It's better to have extra cash on hand, right? This line of thinking tempts borrowers to maximize their loan, treating it like free money to grab. It increases your debt load, which could make it harder to qualify for other credit, like a mortgage or car loan, until you pay it down. Think of it this way. A loan isn't free money. You're renting that money, and the rent is the interest. The more you borrow, the more rent you pay. If you take, say, $5,000 extra just because, but don't have a real use for it, you'll still be paying interest on that $5,000 every month, unless you stash it in an account and pay the loan off immediately, which would defeat the point. You're effectively creating unnecessary debt for yourself. A smarter approach is to calculate how much you truly need. Maybe you get estimates for that home project or add up the bills you want to cover, and borrow close to that amount. Use loan calculators to see what monthly payment fits comfortably in your budget. Ensure you can handle the payments with your income. If you fall behind, you'll incur late fees and possibly damage your credit, which we absolutely want to avoid. In short, more money borrowed equals more risk and cost. Lenders approve a maximum based on formulas and credit info, but you have the choice to borrow less. You're not obligated to take the full amount. Financially savvy borrowers often take slightly less than the max they qualify for, just to give themselves breathing room. Remember, you can always save up or borrow again if truly needed, but you can't wish away a chunk of debt you didn't actually have to take on. So the myth, "take the max," is misguided. Borrow what fulfills your need, and no more. Your future self will thank you for avoiding extra debt. We've reached the end of our personal loan myths debunked journey. Let's quickly recap the truths we've learned. Personal loans aren't as hard to get as people think. With a regular income and okay credit, approval can be fast and simple. They're not all sky-high interest. In fact, they often beat credit card rates, helping you save money. Handled responsibly, personal loans can improve your credit over time, not destroy it. You don't need perfect credit or any collateral to get one. There are options for various credit levels, and most loans are unsecured. Personal loans are versatile. You can use them for many purposes, just not college tuition or a home down payment, to better your life or finances. It pays to shop around for the right lender and loan. Terms and rates vary a lot, and you want the best deal from a trustworthy lender. You can have more than one loan if needed, and if you qualify, just be careful not to overextend. Personal loans have a clear payoff timeline, meaning they can help you get out of debt systematically, rather than trapping you indefinitely. Only borrow what you need, even if a lender offers more. Extra debt is not a bonus, it's a burden. By busting these myths, we hope you now have a clearer understanding of the truth about personal loans. Remember, a personal loan is just a financial tool. Like any tool, in the right situation and used correctly, it can be incredibly helpful. Think consolidating debt or covering an important expense at a reasonable cost. But used poorly or misunderstood, it can cause trouble. The key is knowledge, and now you have it. Thank you for watching and learning with us. If you found this information useful, please give us a thumbs up and consider subscribing for more finance insights. Have any personal loan experiences or questions? Drop them in the comments. We'd love to hear your truth and perspective. Until next time, stay informed and borrow smart. By knowing the facts versus myths, you can make the best decisions for your financial future. Happy borrowing and take care.